FAR.F4.M2.
So, Jenna, I think this might be one of the most deceptive modules in FAR. It doesn't look long. It doesn't have complicated calculations. Then the exam asks one question about contingencies, and suddenly you're wondering whether you're supposed to accrue something, disclose something, or pretend it doesn't exist.
That's exactly why this topic matters. The rules themselves aren't difficult. The difficult part is recognizing which rule applies. Once you build the right decision tree, almost every contingency question becomes much more manageable.
I like that. A decision tree instead of memorizing 20 random rules.
Exactly. This module is really about making decisions. Every fact pattern asks the same basic question. Something uncertain happened. How should it appear in the financial statements? Everything else flows from that.
So, let's start with what a contingency actually is.
A contingency is an existing condition or situation whose final outcome depends on one or more future events. The uncertainty already exists today. What hasn't happened yet is the event that settles the uncertainty. That's important because students sometimes think a contingency means something that might happen in the future. That's not quite right. The uncertain condition already exists. You're simply waiting to see how it ends.
That's a subtle distinction. It's like a lawsuit that's already been filed. The uncertainty isn't whether someone might sue someday. They're already suing. The uncertainty is whether they'll win, lose, or settle.
Exactly. The uncertainty already exists. Now, the accounting depends on whether we're talking about gains or losses. And this is one of the biggest mental divisions in the module.
Which immediately feels unfair. Accounting treats bad news differently from good news.
It absolutely does. Loss contingencies receive one set of rules. Gain contingencies receive another. Don't try to force them into one framework because they intentionally aren't symmetrical.
That's actually a good memory aid. If I catch myself saying, well, if we recognize losses this way, then gains probably work the same. Quote, I'm probably about to miss the question.
Exactly. Accounting is conservative. It's much quicker to recognize expected losses than expected gains. That's the philosophy underneath this entire chapter.
Let's tackle gains first because they're actually simpler.
A gain contingency is a possible future increase in assets or reduction in liabilities. Examples include things like favorable lawsuit outcomes or possible tax refunds. Here's the important rule. Even if the gain looks very likely, you generally do not recognize it in the financial statements. Instead, if realization is probable, you disclose it.
So, accounting says great news. Don't celebrate yet.
Pretty much. The concern is that recognizing uncertain gains too early could mislead users of the financial statements. Until the gain is actually realized, accounting remains cautious.
I like thinking of it as refusing to count your winnings before they're actually in your pocket.
That's a useful analogy. The only place it starts to break down is remembering that the guidance is specifically about uncertain gains. Once the uncertainty disappears, you're no longer dealing with a gain contingency. Now it's simply an asset or income that gets recognized under the normal accounting rules.
Now, let's move to losses because this is where most exam questions live.
Definitely. Loss contingencies require a two-step analysis. First, how likely is the loss? Second, can you reasonably estimate the amount? Those two questions drive every accounting decision.
So, before I even think about journal entries, I'm asking likelihood first, not dollars.
Exactly. Students often jump straight into estimating the amount, but if the likelihood requirement isn't satisfied, it doesn't matter how accurate your estimate is. You may never record anything.
Okay. Walk me through the probability categories.
The textbook gives 3. Probable, reasonably possible, remote. Those 3 words determine nearly everything.
Let's start with probable.
Probable means the future event is likely to occur. If the loss is probable and can be reasonably estimated, then you accrue the loss. That means recording both an expense and a liability.
So probable plus estimable equals journal entry.
Exactly. That's one equation worth remembering. Probable, estimable, accrue.
But then comes the twist. What if I know the loss exists, but nobody can pin down the exact amount?
The textbook addresses that directly. If one amount is the best estimate, accrue that amount. If you have a range and no amount within the range is more likely than another, accrue the minimum amount in the range. Then disclose the possibility of additional loss.
That's one of those rules that feels strange. Why the minimum?
Think about conservatism again. You're recognizing a liability only to the extent supported by available evidence. If accounting can't justify one number over another, it starts with the minimum supported amount and tells readers additional losses are possible.
So if the possible loss ranges from $100,000 to $250,000 and every amount is equally likely, I record 100,000, then disclose the rest of the range.
Exactly. That specific situation shows up frequently because students often average the numbers. Do not average them. That's not what the textbook says.
Good catch. Never invent a formula that accounting never gave you.
Exactly. Follow the rule that's actually written.
Now suppose the loss is only reasonably possible, not probable. What changes?
Now you stop accruing. Instead, you disclose. The notes explain the nature of the contingency and, if possible, estimate the loss or range of loss. No journal entry. Only disclosure.
So the liability hasn't crossed the recognition threshold yet. It's important enough for readers to know about, just not strong enough for the balance sheet.
Perfect way to think about it.
And then we reach remote, which basically means accounting shrugs.
Usually, most remote contingencies receive neither recognition nor disclosure, but there's an important exception: guarantees. Certain guarantee-type remote contingencies are still disclosed.
That's one of those exam traps. People memorize remote equals ignore. Then the exam quietly inserts the word guarantee.
Exactly. Always read every word. One exception can completely change the answer.
Let's summarize the whole decision tree. Probable and estimable. Accrue. Reasonably possible. Disclose. Remote. Usually ignore, unless it's one of those guarantee exceptions.
Exactly. If you can say that without hesitation, you've mastered the heart of the contingency rules.
Now let's talk about something that confused me the first time I learned it. Premiums. Because I kept thinking about bond premiums. Completely different topic.
Very different. These premiums are promotional offers companies use to encourage sales. Think coupons, giveaways, or merchandise customers can redeem later. Those future redemptions create expected costs.
So every coupon isn't just marketing. It's potentially creating a liability.
Exactly. The company knows that some outstanding coupons will eventually be redeemed. If those future costs can be reasonably estimated, they should be accrued in the same period as the related sales. That's another application of matching.
I picture a restaurant giving out, buy 10 coffees, get one free. The moment they hand me that loyalty card, they've started creating a future obligation.
That's a great analogy. The only refinement I'd make is remembering that not everyone redeems their coupons or rewards. That's why the liability is based on expected redemption, not total coupons distributed.
So the company estimates how many people will actually come back, not just how many coupons exist.
Exactly. Outstanding coupons. Expected redemption percentage. Cost per redemption. Those ideas determine the estimated liability.
Now, warranties feel similar.
They are. They're another example of a loss contingency. When a company sells products with warranties, it expects some products will require repairs or replacement. Those expected costs are recognized as warranty expense when the related sales occur, not months later when customers finally bring products back.
That's another matching principle. Revenue today. Expected warranty costs today, even if the repair happens next year.
Exactly. Then, when actual warranty work is performed later, the company reduces the liability instead of recognizing new warranty expense. Students sometimes confuse those two steps. Recording the estimate creates the liability. Using the liability later doesn't create another expense.
I think of it like putting money into a repair fund. The expense happens when you decide you owe it. Actually paying for the repair just spends money that was already set aside.
That's a helpful mental picture. Just remember it's an accounting liability rather than literal cash sitting in a separate account. But conceptually, it's a very good way to remember why the expense doesn't happen twice.
Let's zoom back out. This whole module is really asking one question over and over. How certain are we?
Exactly. Accounting isn't trying to predict the future perfectly. It's deciding whether today's information is strong enough to justify recognition. The more certain the expected loss becomes, the more likely it belongs in the financial statements. The less certain it is, the more likely it belongs only in the notes, or nowhere at all.
And gains get held to an even stricter standard because accounting doesn't want companies recognizing optimistic outcomes before they actually happen.
Exactly. That's the conservative philosophy running through the entire module. It's why gain contingencies and loss contingencies follow different paths.
Let's finish with the mental map. First, identify whether it's a gain or a loss. Second, if it's a loss, classify it as probable, reasonably possible, or remote. Third, ask whether the amount can be reasonably estimated. Fourth, apply the correct treatment. Accrue, disclose, ignore, or remember the guarantee exception.
Then don't forget the practical applications. Premiums and warranties aren't separate theories. They're simply common situations where those contingency principles are applied. If you understand why those liabilities exist, you'll recognize them much faster on the exam.
So, instead of memorizing isolated rules, build the decision tree. Once the tree is solid, every question becomes a matter of following the branches instead of guessing.
Exactly. And that's what FAR rewards. Not memorizing dozens of disconnected facts. Recognizing the situation, following the framework, and letting the accounting flow from there.